Hey there, investors! Ever wonder why a stock tanks even when the company seems to be doing well? Here's the deal. It's not just about the company itself. The stock market is like a giant mood ring, reflecting everything happening in the world. Think of it like this. You wouldn't buy a beach house if a hurricane was about to hit, right? The same goes for stocks. Global events, economic data, even political dramas can rock the market, impacting your portfolio in a big way. We're talking interest rates, inflation, industrial output, stuff that might sound boring, but trust me, it's money-making or, well, money-losing knowledge. So buckle up. We're about to dive into the wild world of macroeconomics and how it shakes up the stock market. First up, let's talk about the big dogs, central banks. In India, that's the Reserve Bank of India, or RBI. These guys control the money supply and set interest rates, which is kind of like the price of money. Lower rates mean borrowing is cheaper, encouraging businesses to expand and people to spend more, boosting the economy. Higher rates do the opposite, tapping the brakes on inflation. Think of it like this. When rates are low, it's like happy hour at the stock market. Everyone's bullish, buying stocks and pushing prices up. But when rates rise, it's like last call. Investors get cautious, pulling back on spending, and the market can take a dive. That's why every word from the RBI governor is analyzed like it's the Da Vinci Code. Next, let's talk about inflation, the silent portfolio killer. It's when prices for goods and services go up over time. We measure it using indexes like the Wholesale Price Index, or WPI, and the Consumer Price Index, or CPI. WPI tracks prices at the wholesale level, while CPI looks at the retail level. High inflation is bad news. It eats away at your purchasing power, meaning your money buys less. That can lead to lower consumer spending, slower economic growth, and ultimately, lower stock prices. That's why investors freak out when inflation numbers come out higher than expected. It's a sign that the economy might be overheating, and the central bank might have to step in with those dreaded interest rate hikes. Now, let's check the pulse of the industrial sector with something called the Index of Industrial Production, or IIP. It measures the output of factories, mines, and utilities, giving us a snapshot of how busy or, not so busy the economy is. A strong IIP reading signals economic growth, which is good for stocks. Why? Well, because it means companies are producing more, selling more, and making more profits. On the other hand, a weak IIP can be a red flag, suggesting a slowdown in manufacturing and, potentially, the overall economy. It's kind of like checking the engine temperature of a car. You want it running hot, but not overheating. Another key indicator is the Purchasing Managers Index, or PMI, which surveys purchasing managers at manufacturing companies. They're the folks who order raw materials and supplies, so they have a front-row seat to the economy's performance. A PMI reading above 50 indicates expansion in the manufacturing sector, while below 50 signals contraction. This index is a leading indicator, meaning it can predict future economic trends. A rising PMI is a bullish sign for the stock market, while a falling one can signal trouble ahead. It's like having a crystal ball, honestly, giving you a glimpse into the future of the economy.